Hi Santosh, how are you? Welcome to Masterstroke.
Thanks a lot for having me here, and it's great to be here.
Thank you so much, and it's good to have your perspective. But first things first, Santosh. Markets तो रुकने का नाम ही नहीं ले रहा. What is the fund house view? What is your view?
See, the way we think about the market is the market को तो जो करना वो करता रहेगा. So, so that's the first part of the equation. And then if you are thinking, say, 5 years, we are we are going on an uptrend because of all these five factors which are favorable for us. But if you are thinking short term, definitely it seems like that markets have run up a bit. And now, for me, given see, there are multiple uncertainties which are going to come in next 1 year, right? The biggest uncertainty is our elections. Okay, so with that uncertainty in mind, you would rather want to go with some sort of buffer available in valuations rather than a stressed valuation. Because with stressed valuation, what happens is if anything goes negative, you get a big downside. Hopefully, those uncertainties is in our mind rather than anywhere else. Hopefully, everything goes all right. Then, other than that, there is this interest rate, which is seems like recently I heard Jimmy Dimon saying that we are looking at 7.5% in US. So, if we are looking at, and for some time, right? If you look and you look at the US mortgage rates, right? Those are at some of its lifetime high rates, right? Multiple decade high rates. I will not say lifetime high, decade high rates they're at. So definitely there are uncertainties and the valuations are a bit stressed. But yes, I would think if you're a long-term investor, you should not worry. But at the same point in time, I would think it's a sideways market.
In my life, and you know better, Santosh, I have seen that, and correct me if I'm wrong, what you view. When we think that market is overpriced, markets tends to go further up. And
Yeah.
when we think selling has happened, market has crashed and it's time to buy, markets drops by another 10-15%. So one thing which I have done in the past, knowingly, unknowingly, is that जब ऐसा लगता है अति हो गई, तो 2-4 महीने में देखते हैं मार्केट 10% और तेज हो जाता है. जो लास्ट का 10% है, वो बहुत क्रूशियल होता है. Do you think we can still see that in the market's upside, that it can surprise everyone by going up from here also? And I don't mean it will stay there forever before coming down, but then again, it is still possible, isn't it?
See, it's quite a possibility. See, markets may one thing you can never say that I know the market is going to go up or down. Yeah? Like it's a impossible thing, and that's why I never get into that hazard guessing game. That okay, it can go down or go up. It can anyways, and as you rightly pointed out, and if you look at the rally also, people are saying that this market is overpriced for almost like when the market was at 18,000 or so. Okay, and this is a much hated rally because a lot of people have not been able to participate in it. So I've always seen that when a rally in which you can't participate becomes a overvaluation game. So it's also a little bit of sour grapes as well because it's the participation has been very low for that matter of fact. So, but I would say valuation wise a bit it's in a zone where I'm not very comfortable in and being aggressive in the market, but you can't actually come out of the market. And I'm being a long-term investor. See, you have to be bottom up, choose your stocks and wait for it. Why keep timing the market at all point in time? Right? It's the asset allocation which you can change, but if at the stock level, you should be rather staying with the stocks rather than doing multiple things with it.
So those, one thing which I see in the mutual fund industry is that debt is, of course, a no story kind of thing, because you know that some kind of, prediction you can, as an investor, you can do that key. Okay, I will get 5 or 6 or 7. There's some kind of, relativeness in debt. But one of the most boring products is balanced funds, balanced advantage funds. Kuch hota hi nahi hai. But still you say that you have made it very attractive. So what is the attractive proposition of your balanced advantage fund?
So yeah, what you're saying is right. It's supposed to be the attraction of the product is it's boring. Right? That's the attraction. In the market in a segment which can give you heart attacks, it's a boring product. Right? And see, I would say the way we are looking at it, and I would not say this is the competition does fantastic job on this product because they are the ones who have created the project. We are the new ones, right? And we are the ones who are learning the product rather than we are the ones who are creating the product. We are not the ones who are creating the product. We are learners. But being learners sometimes is good, you know. And what it tells you, what it makes you do is it makes you sort of work on the product itself. So what we have done is a balanced advantage fund, how we see it, it's an allocator fund, right? It's an asset allocation fund. So you allocate between equity, debt, arbitrage based on the market conditions, right? And then a lot of times what you see is that the funds tend to be a little bit passive on the equity side and making money through the asset allocation side. Right? So you can gather a lot of the upside from Nifty and give slightly lesser when the Nifty goes down. And that way you can be much better placed. Right? What we have done is we have made, see, we have an asset allocation policy which is active. But what we have done is within equity also, we are very active. Right? So the way we manage balance advantage for us is it's an active. I call it to all the people who talk with me that it's an active product. We are not managing a passive active product where equity is passive and allocation is active. We are doing everything on the active side. Now, there are advantages and there are disadvantages. Right? The advantage is that if you get it right, you make a lot of alpha. The disadvantage is that you will have slightly higher volatility. But what I say is that, okay, my peer group is giving you 40% of Nifty volatility, 40% of Nifty, I will give you 50% of Nifty. Okay, but I'll still be half of Nifty only, and so I'll not try to make it closer to Nifty. But I would like my returns to be closer to Nifty. So if I'm able to achieve that, then I'm giving you a product which is 50% volatility and closer to Nifty returns. So I'm happy with it, right? So that's what we have tried to do. We have tried to be very, very active on the equity side, be it the across market cap allocations, across sector allocations. We have been very active.
So that's nice. Santosh, I guess you have been managing this particular fund for around 18, 20 months now. And I looked at the data. The performance is superb. But I will play the devil's role here. I will try to have my own understanding if I'm missing out here. Is it because of the active selection of stocks and active action plan of yours, or a major portion of it is because markets have run up? So if you can give some idea about your allocations a year and a half back and today, at what levels the equity you have managed, what is the highest level of equity you have gone in the last 18 months, and how much of this market rally has helped you? And do you think that probably you got a little lucky here? I'm sorry, but I'm just trying to scratch your mind.
You are absolutely right. And I always make this point that, okay, in your life, hard work is one, but you need luck, right? And near-term performance are more luck than hard work, you know. So I never say that the performance comes to say in 5 years, whatever you have done, your luck tends to have a lower impact in 5 years. In 6 months, 12 months, your luck has a bigger impact than your hard work or your brilliance, right? In 6 to 12 months, that's the case. And that's very clear to me, right? So whenever someone tells me that your fund has done really well in this period, I tell them that, okay, if it is my doing, then we will know it after 5 years. But let's focus on the process, right? Let's focus on the process, because to me, fund management is not about outcomes. It's and I've been a research guy for so many years, right? And I only believe in one thing, that what you can control is input. You can't control the output. What market does is it's market's call, right? It goes up, comes down, whatever it does, right? What you can control is the input part of it. So if you allow, I can share a few slides, right? 3, 4 slides.
Yeah,
I can
please.
share, and then we can the slide is visible to you?
Yes.
Okay. Should I make it? Okay. So it's a pure process based. So for me, any activity which we do is pure process, right? It's nothing to do with outcomes. Outcomes will come if you follow the process. So the fund has 3 key features, right? When you talk about a balance advantage fund, the key feature is that it's an allocator fund where the allocation is decided by And we have got a very good quant matrix, which is called as Motilal Oswal valuation index, right? That index, we call it MOVI, and it's a published index. It's visible on our website daily. You can see our MOVI levels daily on our website, and that MOVI levels tells me where the market valuations are. Right? Now, so that is the key criteria of me determining how much allocation to equity I am going to do. That's one. But at the same time, if I use market trends and all other data which is available to me, and if I find that I'm getting a short-term positioning where I can actually for 2 months, 3 months, I can be higher equity, I use that higher equity positions, right? But that's not by buying and selling in the cash market. That is by use of arbitrage positions. Okay. Now, so that's one part. Second is, see, we are, as I told you, we do a very active asset allocation, right? We do a market cap, asset allocation, sector allocation, everything is very, very active. Now you talked about that. Have we done anything? How does the asset allocation? So this is the last 1 year equity allocation. And what you could see is that in the month of March, when things were looking very bad, right? The stocks were falling, and especially small caps. People used to tell me, yeah, small caps are going to die. Because every day I saw on 27th, 28th of March, things were just falling like 3-4% down in small cap and all. So that was, we used March and April to go contra, and we increased our equity position to almost 70%.
This is very interesting, and this is data. And in hindsight, it looks to be a brilliant decision. In March and April, you are saying when markets were just starting to go up, and markets are up by 15-20% from that level. Brilliant.
Yeah, so moved our equity position by to 70%. Actually, if this is only up to August data, but because but as I see today, we have cut it down by end of September. We actually cut it down to 51. Okay, so we do a very active asset allocation, but the key thing is not this, because this is one part of it. The bigger part is, I'll tell you the other slide, which is, you can see that actually we moved our small cap allocation to almost 35%. The current allocation is closer to 20 in September. If you look at when the September data is released, you'll find that the small cap is now 20. But by March, actually, we kept on increasing because we saw the opportunity that there is so much of negativity built in that particular segment of the market. So we moved our small cap allocation to almost 36% of the fund, right? And there are those small cap allocations, and those are only 3-4 stocks. And I'll come to that, because small cap we don't do. I'll come to how we invest in small caps, because it's a very risky part of the market to be in. So you have to be very vigilant about what you do in that particular space. Okay, so we moved our allocation even in the small cap space, and you will find that the stocks have actually more than doubled all of it, but we have kept the allocation to around 30, and now we have come down to almost 20 to 23%. So we do a very active allocation on the small large caps as well. We don't do like we are sitting only on large caps, and we don't do that. We are very active on that, right? Now it comes to this simple process, right? It's a very simple process how we select equity, because this question gets asked to me that, okay, small caps are very risky or large caps are risky. I said that okay, fine. My equity selection is very, very simple process. See, we have QGLP as the base, right? You know that we are a QGLP practitioner, right? Quality, growth, longevity, and profit after. And your PE ratios, right? The price of the stock. These are the four. QGLP is the core to this. And what we do is, while using the QGLP, for me, the stock selection and allocation, how much you're going to allocate in those stocks, because we do concentrated positioning. What you'll find is Motilal's, none of the portfolios will have 100 stocks. It will have between 20 to 30 stocks, because we believe that we are being paid to generate alpha, and that can be only done if you are good in asset selection. If you are doing 100 stocks, then you can only sort of 70, 80 of them will have 0.5% allocation. What will be the extra in it? So our simple thinking is we have to be concentrated position. And if we are concentrated position, then our stock selection has to be very, very good. Now, so the three simple criteria is that the company has to be in a large space and a growing space. So the first criteria is the company has to be in a large and growing space. Second criteria is again simple. The company in that space has to be a profit leader, right? And third criteria for me, which is very important there, is that I don't buy any stock. At the time of buying, I don't buy it if it is more than 1 PEG. For that, yes, there are exceptions to that rule, and those are the sort of thematics at that time, but those don't become more than 10% of my portfolio. 90% of the portfolio would be at the point of buying will be less than 1 PEG. And that's very clear in my mind. And once the stock starts moving above 1, I keep selling those stocks, reducing my positions. Right? So these are the 4 slides. I thought that this is the process, and I thought I'll put the process in front of you, that what we do rather than what we achieve. And my belief is, if we keep following the process day in, day out, I think in a 3-4 year time span, you will have the long-term data which will show the results. Today, like you, I would also play David. Actually, I play more of a devil advocate in my own fund, that actually this data, you should only look at after 2 years.
Some people are asking what is PEG, if you can explain that.
So it's price to earning growth, right? If I'm getting the P to growth, if I'm getting a company at 20 times P ratio, I need more than 20% growth for next 3 years. That's the minimum. So if I'm getting a company at 50 times, and what you'll find, you can see the portfolio going online, right? It's a disclosed portfolio. I don't have any stock which is 15% growth and 50% sort of and 50p. It will be, if those are there, it will be in that 10% positioning which I have kept for thematics, right? Those are the thematics which can be a big thing going forward, right? Some of the digital stocks which are loss making, but those will be in 10% bracket. Overall allocation can't go above 10%. Sometimes it can go to 12, 13. I don't mind that, but yes, it's a very small bracket where I keep those stocks. The entire portfolio is sub 10 PEG portfolio at the time of buying.
Santosh, I have, and my only job today is to understand the product and the partners at Masterstroke MFD to understand this product better. So I'm trying to ask you some questions, stay minimum with my question. My other question is that how practical it is. So today, Motilal BAF is an actively managed fund.
Yeah.
You have been doing it for last 1.5 years. But somebody who invests in Motilal, जो आदमी investor पैसा डालेगा, वो 5 साल तक hold करेगा. How sustainable and practical it is to have an active portfolio by you or any fund manager in a BAF category for 5 years and 10 years, or the strategy will change?
See, I think I was there in your meeting in the last 2 minutes, right?
Okay.
Yeah, and what you said, I keep telling to my salespeople also, that okay, there would be people who don't want active allocation in equity, and there will be people who want active allocation in equity in BAF. And I am running a product. I will be true to that product, and whatever the circumstances are, I will be true to that product. And there will be buyers of that product if I'm true to it. I don't need the entire 2 lakh crore of equity allocations, no. So 2 lakh or 3 lakh crore of the fund, I don't need it, right? What I need is a small proportion of it, and I need so I need people who can handle active allocation to equity. That's the point. So we are going to run it that way.
So friends, if you have any question, it's a time to, I have one last question, and then if you have any question, we'll take up that. You can write me in the Q&A box or the chat box. So Santosh, I have one final question to you. When I look at data on an academic basis, and when I see the performance of large cap sector per se and a debt fund, let's say a pure debt fund, a short-term fund or a medium-term fund over the last 10, 15, 20 years, and I do a simple math and I take the category average, forget about individual funds performing, and I take the category average. And when I merge a portfolio of 70% equity and 30% debt, I find that some balanced advantage funds have actually beaten this proportion with a better tax adjustment. So there you pay taxes on debt fund, a little higher taxes, whereas in mutual fund, equity mutual funds, the taxes are lower, and BAF enjoys that. Is my understanding correct that without doing any active role on the side of the MFD or the investor, a BAF kind of product, which is 70-30 kind of, as compared to a 70 equity, 30 debt over the last 15 years, would have probably given you, let's say, 11% return on the portfolio. Several BAFs have done far better than that, with better tax adjustment, with peace of mind. Do you think this is a very valid argument in favor of BAF and people don't know about this?
See, to me, I manage different funds, right? I manage 4 funds, and couple of these are pure equity as well. So, and this is one fund I'm always most excited about because it's a sort of flexibility it gives me. It's a fund which never hinders you, right? See, if you believe that something has gone really means if the valuations are really high in the market, and as an equity fund manager, sometimes I would think about that. Okay, I should have the ability to bring my equity allocation down by 35-40%, which is not allowed there. But here you can do it, and then you can do it very dynamically. Right? So so I think it's an excellent product. And then, as I said in the beginning, see, what you are trying to do is you're trying to create the volatility which is 50% of Nifty, and then be closer to Nifty. This is what you're trying to do. So I think that on a risk reward basis, this becomes an excellent product.
So friends, this is one message of this session, I think, which probably you need to go back on your own portfolio, your client's portfolio, and do an analysis that if somebody just invested 70% of his or her portfolio in equity and 30% in debt, what kind of return you made? And if you invested in a BAF product category and stayed there, what is the return? Probably you will be surprised. But we are all made for active investing. We are all made for, as an investor, because we don't do as much research as fund managers. We think that we can beat actively managed by buying actively managed portfolio. But BAF is a portfolio where there's no glamour to the investor and the MFD, but the returns are superior. So this is very eye opener for me, and very interesting. So Santosh, your take on the direction of gold. Sunil is asking, what do you think about gold?
So in BAF, we don't do gold. So that's one part. So I would not, in BAF is not there, but yes, I can give you some because I also manage the multi-asset fund. So, so that was, so that's a different thing. But yes, my thinking is simple. See, from a Indian gold and global. So let's think about dollar denominated gold and India and rupee denominated gold, because when you look at India, the gold values tends to get impacted because of the dollar movement as well, right? So my view on dollar is now a bit sort of, I think Indian rupee depreciation may not happen as sharply for at least 2-3 years. There are so many factors which are going for us. If you look at our currency, it's based on balance of payments. It tracks the fundamental values over a 5-year period, but in a near-term period, it mostly, what our data suggested is it has actually tracked balance of payments. And balance of payments can go in favor of us for at least a couple of years. And that's one because of the bond index inclusion, and that will create a lot of inflows. Also, what we are seeing is that we are getting more attractive as a geopolitical country. So what my belief is that you're looking at not much of depreciation in rupee, which means that one part of your value creation in gold is slightly lower. That is the value being created because of the dollar. Now, second part, which is the sort of gold value in dollar itself going up. So dollar, if you look at gold, it's a step of function commodity, you know, and it's a pure hedge against all the risky assets. Now, what you've seen is there has been a huge run up in gold. The prices have run up quite sharply, and that's because there was a risk of going on across the world. One, because of the Russia, Ukraine, and then because of the global economic environment. But I think there will be some stability. So if I look at the fundamental factors, I would believe near-term volatility aside, the next couple of years we are not going to see big returns from gold.
Nice. One last question we have from Sudipto, and he says that, and he admires your active calls, but what do you see in Zomato and Jio, which most others seem to overlook?
Let's put it this way: that balance advantage doesn't have Zomato and Jio, and I would not. I generally don't like
Just talking about the fund house per se, especially maybe.
So generally, I don't talk about it's actually not right. If I talk about other funds, no.
I agree
And
with you.
balance advantage doesn't have Zomato or Jio in the portfolio. So
Oh, perfect. Any final observation, any final message you would like to give to the audience about your BAF or your style of picking stocks?
So the only thinking process I always leave with is that this is a fund which will be actively managed. That I always say that it's an actively managed fund. Second part is we will be, see, what you will get in this fund is simply over a 1 year period, I would try to be sort of, my volatility will be closer to where everyone else is. So that's the other part of the equation. And third is we'll try to create returns which is closer to the Nifty returns. So I see it as a Nifty minus product rather than a lot of people tell me BAF is a FD plus product. Actually, FD plus,
Oh, nice.
peers have not done FD plus. Peers have done Nifty minus. So it's a
Yes,
Nifty
yes.
minus, slightly Nifty minus product, not a FD plus product. So this is what I want to sort of.
Oh, this is brilliant. I mean, I think we have ended it on a very, very good note of this statement that you made. BAF can be looked as a Nifty minus product with probably half the volatility of Nifty, which is in the world of finance, which is called, sharp ratio, how much risk you are taking to deliver the returns. On that parameter, probably the BAF scores a very high degree of mandate one should give in terms of investment portfolios. Thank you so much, Santosh, for being with us and sharing your ideas. It was very nice to have you on the show. Thank you so much, Santosh.
Thank you.